getting into the crux of the subject, what does the financial and tax diligence actually entail from a transaction standpoint?
Sure thing. So our work primarily entails a deep dive look at the historical financials and tax position of a company. So as an investor, you're going to be looking hard at the historical financials of the business to make sure that they align with your understanding of valuation that you've offered to a business owner. Usually, prior to the point we get involved, someone like yourself has had minimal access to the company and its financial statements, probably some high-level information, but haven't had a chance to deep dive. So what we do is we go in, try to, in a condensed time frame, understand the financials at a very specific level, understand what's going on with the business, understand any add backs to EBITDA, which we can talk about in a minute, what those mean, and just generally try to make sure all the parties have a good understanding of the financial condition of the business and any tax risks that might exist.
Got it. So, I'm sure the list is pretty voluminous, but what information are you going to request from a business owner?
Sure. Some of it will depend on the company and the type of company, but the general things are just detailed financial records, usually for the last 3 years. Usually the period we look at is 3 years back. It may go up to 5 years, but generally 3 years. So detailed financial records of your income statement, your trial balance, some things like detailed sales analysis, whether that be sales and potentially margin by customer, by product line, things like that, again, to get a better and deeper understanding of where the sales dollars and margin of the business are coming from. And then more, typical things would be understanding the accounts receivable position of the company, looking at details of the inventory over time, just to make sure we understand the assets that will be acquired in the transaction. From the tax side, we're going to be making sure that all of your filings are up to date. When looking at it from a state level, that you're filing returns, whether that be income tax returns or sales and use tax returns, in the right states, depending on where you have activity. That can be, one that is a little tricky, because just from time to time, those states like to change the rules, and small business owners don't always have the ability to stay on top of that. And that generally is, again, a 3 to 5 year period where we're looking back at that activity.
So when we look at specific businesses and we're looking at diligence requests, how long does this usually take, and then who from the company is going to be involved? Because we talked, with the legal side, and sometimes business owners prior to a letter of intent, or sometimes even after a letter of intent, don't want to disclose the fact that they're selling the business, but to do all this work on their own might be pretty difficult.
It generally is.
Yeah.
So I think, when you think of it in terms of how long does this process take, it's a bit of a sliding scale. So again, from the financial and tax due diligence side, we're usually the first group to really kick off the detailed due diligence after the letter of intent is signed. So what you're going to get is that first initial list from us, and then there will be, a flurry of activity right away.
Yeah.
And so over the first couple days to a week from when we get engaged and have a kickoff call with the business owner's company, there will be a large amount of data processed right away. Then continuing on over the next couple weeks, there will continue to be some back and forth, but hopefully that's the type, at least on the financial and tax, we can front load that work. And then from there, we're just doing analysis and asking questions. To your point about who should be involved, it's a bit of a sensitive subject sometimes with business owners, who they let know and when in the process.
Right.
But I would say, your key financial person or people are going to be very important to you in this process. It's a lot of information that we ask, analyze, and then have a bunch of questions on, again, to make sure we get a full analysis of the business. So trying to do that without your, whether it be CFO, controller, bookkeeper,
outside accounting firm.
Yeah, whatever it is, without having them understanding what's happening is generally difficult. And The other thing is, you don't want to insult someone's intelligence. If all of a sudden you're asking for a bunch of information and digging through things that you may not have ever looked at before, people will start to figure out what's going on, and oftentimes it's worse for them to speculate on what's happening rather than having that open conversation about why we're asking for these things and how they can be helpful.
One of the other sticking points, I think, from a business owner's perspective in diligence and creates some consternation or worry or concern is generally there's not a lot, but there's personal expenses that would be run through a business, and the business owner entrepreneur is worried that our financial and tax diligence, that it's an IRS audit and they're coming out to get me.
Right.
know.
Right, and I can assure you it's not. This kind of ties back to the conversation we were having before, around why we're asking for a lot of the information we are. And one of the key things we want to understand is adjustments to EBITDA, right? So there's the financial results of your business as you report them. And then, what we're really trying to get to is, okay, well, what are the results of this business as, it would be under future ownership, right? So those are things often like, well, if this is not owned by one individual, you're probably not going to have things like country club dues or, travel that may not be 100% business related, or other things like that running through the business. Wife's car, cell phones, things like that, which, at the end of the day might add up. And, if you're a business owner with, a company that has $3 million of earnings, if there's $150,000 to $200,000 of that type of stuff going through the business, and we can identify that, well, that just makes your company look better, because that's extra cash flow that would be there to service debt, invest in CapEx, other things going forward. So it's all part of the process of just really making sure that we understand what's really there in the business in terms of a recurring level of cash flows. Right,
and at the end of the day, it's beneficial to owners because it increases their EBITDA. We're always paying a multiple, of EBITDA. So that $200,000 can mean, 1 to 1.5, sometimes even $2 million of value.
That's right.
Depending on the business.